AI is quietly forcing people to rethink how they manage their money. Not because AI is some magical technology that suddenly prints cash, but because the stock market is starting to behave in a way that most everyday investors don't even realize. You see, unlike a lot of you morons, I know people in my close circle who have built serious wealth doing something incredibly boring. They simply buy low-cost index funds that track the biggest companies in the market and then leave them alone for years. No constant trading, no chasing hype stocks, no pretending they're some financial genius after watching 2 YouTube videos and opening Trading 212. Just quietly owning a slice of hundreds of the largest businesses in the world and letting time do the heavy lifting. Historically, that strategy has worked ridiculously well. Markets like the S&P500 have averaged around 10% a year over long periods of time. Meaning if you simply owned the market, you benefited as the economy grew. But here's the part most people investing today have absolutely no idea about. When you invest into one of these index funds, a massive portion of your money actually ends up concentrated in just a handful of companies. And right now, almost all of those companies are making the exact same bet: artificial intelligence. Which means millions of passive investors think they are diversified, when in reality, they are heavily exposed to one single technological gamble. And that's exactly why I started looking at this situation a lot more carefully. Now here's the part that should make you pause for a second. When most people invest into a big index fund like the S&P500, they assume their money is spread evenly across hundreds of companies. That's the whole appeal of passive investing. You buy the market and let diversification protect you if a few companies fail. But the reality is very different. For every pound you invest into the S&P 500 today, roughly 40 pence of that money goes into just 10 companies. 10. That's not exactly the kind of diversification most people imagine when they hear the phrase, own the whole market. These companies include names you already know, massive tech giants that dominate headlines, dominate market value, and increasingly dominate your investment portfolio, whether you realize it or not. And one company in particular has become unbelievably influential. Depending on the moment in the market, a single company can take up 7 or even 8 pence of every pound you invest into the index, which means millions of passive investors who think they're spreading risk are actually piling huge amounts of money into the exact same businesses. The reason this happens is because these index funds are what's called market cap weighted. In simple terms, the bigger a company becomes, the larger slice of the index it takes up. So when a handful of companies grow enormous, they start absorbing more and more of the money flowing into passive funds. It becomes a feedback loop. Bigger companies attract more investment. That pushes their stock prices higher, which then increases their weight in the index, which attracts even more passive investment. And before long, the diversified market starts looking suspiciously concentrated. So the obvious question becomes this: why are these companies becoming so large that they dominate the entire market? If you look closely, something very interesting appears. Most of the companies sitting at the very top of the index share one very specific behavior. They are all spending enormous amounts of money on the exact same thing: artificial intelligence. Right now, the biggest technology companies in the world are pouring billions into AI infrastructure, building massive data centers, training increasingly powerful models, and racing to become the dominant platform of the future. On the surface, that sounds exciting. AI could transform industries, automate huge amounts of work, and unlock completely new business models. But here's the part most investors aren't thinking about. For these companies to justify their current valuations, they would need to generate truly enormous levels of future revenue. We're not talking about billions. We're talking about trillions. That means the market isn't valuing these businesses based on what they earn today. It's valuing them based on what investors believe they might earn many years into the future if everything goes perfectly. Now, betting on future growth isn't unusual in the stock market. Investors have always priced companies based on where they think the world is heading. The real issue appears when almost the entire market starts making the exact same bet at the exact same time. Because when that happens, expectations can sometimes move much faster than reality. And this is where things start getting a little uncomfortable. Because when you zoom out, you realize the largest companies in the market are essentially all chasing the same prize. They're building enormous AI infrastructure, funding research labs, buying thousands of advanced chips, and constructing gigantic data centers all over the world. The idea is simple. Whoever builds the most powerful AI systems could end up controlling the next generation of digital infrastructure, and that could be incredibly profitable. But building that infrastructure is unbelievably expensive. Some of these companies are committing hundreds of billions into AI development over the next decade, and a lot of that expansion is being financed with huge amounts of capital flowing through the markets. Which means the current valuations of many of these companies rely heavily on the assumption that AI will generate enormous profits in the future. If that assumption turns out to be correct, these companies could become even larger than they already are. But if expectations move too far ahead of reality, markets can start behaving in ways that look suspiciously like a bubble forming. Because what we're seeing right now isn't just technological innovation. It's also a gigantic financial bet on one single idea. And when huge amounts of capital all chase the same narrative at the same time, the risks can become much larger than most passive investors realize. So after looking at this properly, the obvious question becomes simple. What can you actually do about it? One idea some investors suggest is switching from a normal S&P 500 index fund to something called an equal-weighted index fund. Now on the surface, that sounds like the perfect fix. Instead of the biggest companies dominating the index, every company gets roughly the same allocation. So rather than 40% of your money sitting inside 10 companies, the weight becomes spread much more evenly across all 500 businesses. Which means the giant tech firms no longer control such a huge portion of your portfolio. Sounds great, right? But there's a problem most people don't notice. Equal-weighted funds constantly rebalance themselves to keep every company at the same size in the index. So when a company starts performing extremely well, the fund actually sells some of it to keep things balanced. And then that money gets redistributed into companies that haven't been performing as strongly. In other words, the system ends up trimming the winners and buying more of the slower performers purely to maintain equal weight. Meanwhile, a traditional market cap weighted index fund does the opposite. When companies grow and gain momentum, they're simply allowed to take up a larger share of the index over time. And because those funds trade far less frequently, they usually come with lower costs as well. Which is why, despite some of the risks around AI concentration, many long-term investors still keep the majority of their portfolio inside the traditional index structure. But there's another problem that most investors never even think about. When you only invest in something like the S&P 500, you're effectively making a very specific bet. You're betting that one country will continue dominating the global economy for decades to come. Now, to be fair, over the past decade, the United States has absolutely dominated the stock market. But history shows that economic leadership doesn't stay in one place forever. If you go back to the early 1900s, the United Kingdom was actually the financial center of the world. London was the powerhouse. British companies controlled global trade, and investors back then probably assumed that dominance would last forever. But it didn't. Fast forward several decades and another country started taking center stage. Japan. In the late 1980s, Japanese companies were dominating sectors like electronics, automotive manufacturing, and technology. At the time, many investors believed Japan would eventually overtake the United States economically. Yet history once again took a different path. The point is simple. Markets change, economic power shifts, and no country stays on top forever, which is exactly why some investors prefer spreading their investments across the global market rather than relying entirely on one single economy. Now, while a lot of investors are arguing about diversification and global markets, there's another way to think about where the real opportunities might appear from AI. Instead of just looking at countries or index funds, I like to break the market into a few different zones. Each zone represents a different type of company and a very different type of investment behavior. The first one is what I call the crowded zone. These are the massive companies everyone already knows, the giants sitting right at the top of the market. Think of the huge tech firms dominating headlines, dominating media coverage, and dominating index funds. This area is crowded because billions of pounds are constantly flowing into the exact same names from passive investors all around the world. Below that, you have what I'd call the defensive zone. These are companies with extremely stable demand, businesses people rely on, regardless of what the economy is doing. Supermarkets, global consumer brands, healthcare giants, and infrastructure companies often sit in this category. They might not grow explosively, but they produce consistent profits year after year. Then you have the speculative zone. These are companies with massive hype, but very little proven profitability. They often surge in popularity during tech booms when investors start chasing the dream of the next big breakthrough. And finally, there's the zone that tends to get the least attention, the overlooked zone. And interestingly, this is where some investors believe a lot of the real opportunities around AI might actually appear. The overlooked zone is where things start getting interesting, because most of the attention right now is focused on the giant companies building the most powerful AI models. Everyone is watching the big tech firms pouring billions into chips, data centers, and massive research teams. But here's the question many investors are starting to ask. What if the biggest profits from AI don't actually go to the companies building the technology? What if the biggest winners are the companies that simply use that technology better than everyone else? Because something interesting is already starting to happen in the market. Many startups and mid-sized companies are now building software that allows users to choose between different AI models. Instead of locking people into one system, they allow users to switch between multiple providers depending on price, speed, or performance. And when technology becomes interchangeable like that, competition usually turns into a pricing battle, which is great for customers, but not always great for the companies that spent billions developing the technology in the first place. Because once something becomes widely available, the real value often shifts away from the creator and toward the businesses applying it in smarter ways. But AI isn't the only thing changing the financial landscape right now. Whenever the world goes through a major technological shift, it doesn't just create opportunity, it also creates uncertainty. New technologies reshape industries, shift power between countries, and sometimes even change how financial systems operate. And when uncertainty rises, something very predictable usually happens. Investors start looking for stability. One asset that has historically played that role and has actually been one of the biggest catalysts behind the wealth I've built over time is my good friend, gold. In fact, over the past few years, central banks around the world have been increasing their gold reserves at one of the fastest rates seen in decades. Countries are gradually holding more physical gold as part of their financial reserves, treating it as a form of long-term monetary insurance. Part of the reason for this shift is regulatory changes that now allow gold to be treated as a top-tier reserve asset on many bank balance sheets, which means financial institutions can now hold gold in a similar way to cash or government bonds. That change alone has increased global demand significantly. Now, this doesn't mean investors should suddenly put all their money into gold, but many portfolios include a small allocation simply as protection against large economic shocks. It acts less like a growth asset and more like a financial safety net during periods of uncertainty. And in a world where technology, geopolitics, and financial markets are all evolving quickly, some investors feel that safety net is becoming increasingly important. But perhaps the most underrated part of any investment strategy has nothing to do with AI, gold, or global markets. It's cash. One of the biggest mistakes investors make is not keeping enough liquidity to handle unexpected events in their lives. Because when markets fall and people suddenly need money, they're often forced to sell their investments at the worst possible moment. And that's exactly how long-term strategies get destroyed. Having a healthy cash reserve acts like a financial shock absorber. It allows you to survive downturns without touching your investments, and sometimes even take advantage of them when opportunities appear. Many experienced investors actually increase their cash position when markets start looking unusually expensive, not because they're trying to perfectly time the market, but because they want flexibility if prices fall. At the end of the day, the truth is very simple. Nobody knows exactly what the market will do next. Artificial intelligence could drive another decade of massive growth. Or expectations around AI could prove too optimistic and lead to a period of correction. Instead of trying to predict the future perfectly, many investors focus on preparing for multiple outcomes. They stay invested in the market, diversify across different regions and sectors, hold a small allocation to defensive assets, and keep enough cash available to navigate whatever comes next. Because in the long run, successful investing isn't about guessing the future. It's about building a strategy that survives it. So ask yourself this one question honestly, and maybe, just maybe, you might make it into the top 5%. Are you actually investing with a plan, or are you just copying what everyone else is doing? Remember, you can lie to everyone, but you can't lie to the person you see in the mirror every day.